This week, three financial signals converged, directly affecting every American household, regardless of stock market investment. Gas hit $4.11 a gallon nationally, up 38% from $2.98 before the Iran war began. In under 6 weeks, it's the first time gas has been this expensive since August 2022. Countries across Asia ration energy,
tracing its origins from the early colonial period to its significant impact on the development of America.
The OECD raised its U.S. inflation forecast to 4.2% for 2026, the highest in the G7, up from 2.6% last year, more than double the Federal Reserve's 2% target. The U.S. now has more projected inflation than the U.K., Canada, France, Germany, Italy, and Japan combined in the G7. The Dow entered correction territory, down approximately 10% from its February all-time high. The Nasdaq has fallen 13%. Goldman Sachs warns the S&P 500 could reach bear market territory, a 22% decline. If oil disruptions persist, three signals, all real, all affecting your wallet. I am the silent shift. In the next 13 minutes, I'll explain every signal clearly, show connections, and give you a 7-step money survival guide. Some of these steps need to happen this week. A few need to happen tonight. Let me start with gas because it is the most visible and immediate. Signal: most people are dramatically underestimating its actual impact on their budget. Yes, gas at $4.11 costs you more directly when you fill up. But the gas pump is actually the smallest part of the problem. Here is the supply chain reality. Everything in the U.S. economy moves by truck. Food from farms to warehouses, goods from warehouses to stores, packages from distribution centers to your door. Every single one of those trucks runs on diesel. When diesel costs 38% more, every delivery cost increases by roughly 38%. Those costs do not stay with the trucking companies. They get passed to the manufacturers who use them. Manufacturers pass them to retailers. Retailers pass them to you. The mathematical certainty is that food prices, delivery fees, and consumer goods prices will be rising over the next 60 to 90 days. As these higher fuel costs work their way through the supply chain, this is the lag that makes the gas price spike dangerous. People see $4.11 at the pump today and think that is the full cost. It is not. The full cost shows up at your grocery store and on your Amazon orders in late May and June. In Europe, the situation is already more acute. Shortages forced Italy to limit fuel supplies at several airports. Countries across Asia have already started rationing energy. The U.S. has not yet hit those levels of acute shortage. But we are in the same inflationary trajectory on a slightly different timeline. The practical implication: buy non-perishable food and household essentials now, not in panic quantities, but in normal bulk quantities that lock in today's prices before the supply chain inflation arrives at retail shelves. This is not speculation. This is supply chain math working on a predictable schedule. The OECD inflation forecast is a signal most people will scroll past without understanding its significance. Let me translate it. The OECD raised U.S. inflation to 4.2% for 2026, the highest in the G7. That is up from 2.6% last year and nearly double the Federal Reserve's 2% target. What does 4.2% inflation actually mean for your specific financial situation? If you have $10,000 in a standard savings account earning 0.5% APY, you are losing $370 in real purchasing power every year. Not because the number on your statement goes down, but because what that $10,000 can buy goes down by $370 worth of goods annually. If you have $50,000 sitting in cash or a low-yield account, you are losing $1,850 per year in real value, silently, invisibly, without any statement showing a loss. The best high-yield savings accounts currently pay around 4% APY. At 4% yield against 4.2% inflation, you are still losing slightly in real terms, but dramatically less than the person in a 0.5% account. The difference between 0.5% and 4% on a $50,000 emergency fund is $1,750 per year in interest. That is money you are currently leaving on the table every year. The Federal Reserve cannot cut rates aggressively in a 4.2% inflation environment without risking making inflation worse. This means mortgage rates stay elevated, car loan rates stay elevated, credit card rates stay elevated. Anyone carrying variable rate debt is being squeezed on both sides, higher prices on goods and higher costs on borrowed money. The U.S. having the highest inflation in the G7 is not just a macroeconomic statistic, it is the specific financial environment your money is living in right now. And most people's financial setup is not positioned for it. The Dow entering official correction territory, defined as a 10% decline from a recent high, is the signal that triggers the most fear and the most bad decisions among ordinary investors. Let me give you the historical context that should change how you feel about this number. Since 1950, the stock market has entered correction territory, down 10% or more, 26 separate times. The average recovery time from a correction back to previous highs has been approximately for months, not for years, not even for quarters, for months on average. The investors who sold during corrections took an average of 7 months longer to recover their losses than those who simply held their positions, because selling during a correction means you lock in your losses and then have to time your re-entry correctly, which almost nobody does successfully. You end up selling low and either buying higher on the way back up or missing the recovery entirely. Now, the honest caveat, not every correction ends in for months. Some corrections turn into bear markets. Some bear markets turn into prolonged declines. The 2008 crisis took 4 years to fully recover. The dot-com crash took 7 years. These are real outcomes that real investors experienced. But here is the data point that should anchor your decision-making. The S&P 500 has never, not once, produced a negative total return over any rolling 20-year period, including through the Great Depression, including through World War II, including through every recession, bear market, oil shock, and geopolitical crisis. In the 20th and 21st century, the investor who holds a broad index fund through this correction will, based on 100 years of consistent historical data, come out ahead of the investor who sells in fear. The only investors for whom this is not true are those within a very short time horizon, specifically, people who need their money back within the next 12 to 24 months. Here is the synthesis that most financial commentators are not explaining clearly. These three signals, gas at $4.11, inflation at 4.2%, and the Dow in correction, are not three separate problems. They are three symptoms of one underlying condition. The oil shock from the Iran war closing 20% of global oil supply is the root cause of all three. Oil drives gas prices directly. Oil drives inflation through supply chain costs. And inflation fears, specifically the fear that the Federal Reserve will not be able to cut rates because inflation is too high, is what is suppressing stock market valuations and driving the correction. This means all three signals would reverse together if the underlying cause resolves. A ceasefire or Strait of Hormuz reopening would immediately push oil prices lower. Lower oil prices would reduce near-term inflation expectations. Reduced inflation expectations would give the Fed room to cut rates. Rate cut expectations would push stock prices higher. All three signals moving in the same positive direction simultaneously. The flip side is also true. If oil remains elevated through summer, all three signals continue to worsen together. Inflation climbs further, the Fed remains constrained, and the stock market faces continued downward pressure. This interdependence is why the Iran ceasefire news is the single most important financial variable right now, not any specific stock, not any Fed decision. The Iran war resolution, or lack thereof, is the lever that moves gas prices, inflation, and the stock market simultaneously. Here are the 7 steps for this specific environment. All of them are relevant right now. Some of them need to happen today. Step 1. Move your emergency fund to a high-yield savings account today. Stop losing real money to inflation. The best money market accounts currently pay around 4% APY. Against 4.2% inflation, you are still slightly behind. But you are dramatically less behind than the person earning 0.5%. Open an account at Ally, Marcus, Fidelity, or Schwab in 10 minutes. Move your emergency fund there today. Step 2. Book any travel you have planned in the next 12 months this week. Airline ticket prices are directly linked to jet fuel costs. Jet fuel costs track oil prices. With oil at over $110 per barrel, airline pricing pressure is real and escalating. The ticket you buy today is cheaper than the ticket you buy in June. Book it now. Step 3. Buy non-perishable food and household essentials in bulk this week. Not panic buying. Strategic buying. Pasta, rice, canned goods, cleaning supplies. Paper products, anything that does not expire quickly and that you will use regardless. You are locking in today's prices before the 60 to 90-day supply chain inflation lag hits retail shelves. Step 4. Pay down every dollar of variable rate debt you can this month. Credit cards above 20% APR. Variable rate car loans. Home equity lines of credit. With the US at 4.2% inflation and rate cut expectations being pushed further into the future, variable rate borrowing costs are likely to stay elevated or rise. Every dollar of variable rate debt you eliminate removes a financial pressure point from your budget. Step 5. Do not sell your long-term investment portfolio in response to the correction. I know I have said this before in previous videos. I am saying it again because it bears repeating every time the market drops. The 26 corrections since 1950. Average recovery time for months. Investors who sell take 7 months longer to recover than investors who hold. Hold your investments. Step 6. Increase your monthly investment contributions if your emergency fund is funded. This is the counterintuitive move that Step 7 will reinforce. The Dow at minus 10% means every dollar you invest right now buys 10% more of the market than it did in February. If you are a long-term investor, a 10% discount on the entire US stock market is not a reason to stop investing. It is a reason to invest more. Step 7. Watch the Iran ceasefire news very closely this week. As I explained in Section 4, the Iran war resolution is the single lever that simultaneously affects gas prices, inflation expectations, and stock market valuations. When a credible ceasefire signal emerges, and based on the talks currently happening through multiple mediators, it could come any day, the market response will be swift and significant. Oil could drop $20 to $30 per barrel in a single day. Stock markets could rally 3 to 5% in a single session. The people who are invested when that happens will capture those gains. The people who sold in fear will watch from the sidelines. This is the most important investment positioning call of the current period. Stay invested. Stay patient. And watch the ceasefire news. Gas at $4.11. US inflation the highest in the G7 at 4.2%. The Dow in official correction territory. These are real signals that deserve real responses, not panic. Real responses. The 7 steps I gave you are your real responses. Move your emergency fund to 4% APR. Book. Travel now. Buy essentials in bulk. Pay down variable rate debt. Hold your investments. Increase contributions if you can. Watch the ceasefire news. The people who take these 7 steps in the next 7 days will be in a meaningfully stronger financial position than the people who watch the news headlines and freeze. Volatility creates opportunity for the people who are prepared. It creates damage for the people who react with emotion. You watch this video. You now understand what is happening better than most Americans. Now act on it. Subscribe to The Silent Shift for daily finance moves that cut through the noise and give you what you actually need to know. The shift is quiet, but it is already happening.